See that the narrative is also now that the trade, we don't want Trump to talk so much about the tariffs and all that, because then we have a bad day in the stock market. But it seems like it's kind of moving in the background now, and again the markets have been moving up. I start to hear people saying now, oh well, Henrik, why now should we get a downturn at some point? So I think that's the good news. That's that we don't see it at this point here. The bad news is that the second part of the other part of the economy, you have the housing market, you have the labor market. These are the two big ones. You can just think of, from yourself. If my house is okay, it doesn't depreciate in value, you're okay. If it appreciates, you feel a little more wealthy and you'll spend a little more. But even more important is how you feel about your job security. So if you got a secure job, then you feel better and you feel that you can, spend more. But if both of these start to deteriorate, then it's, not a good thing. And we are only in a situation now where the good news is that the labor market still is strong, but the housing market doesn't look very strong, and actually looks very, very bad in the US. And we see house prices starting to decline. We see that it's frozen solid in terms of the number of new homes sold. We see mortgage applications are down in the gutter. We see that the affordability index is down in the gutter, and all these the economic slowdown. Well, then you could see that this can actually just exacerbate the size of this crisis here. So and also there are other indices that shows that we may have seen a very big top. It doesn't roll over immediately. And if you look at there's a Philadelphia housing market index as well. If you look at that, seems like to me, it's made a very big top. It did the same in 2005. And it took some time before you saw then the crisis setting in, a year and a half, 2 years later. But this one is also an important factor that I'm saying that, well, I think we've seen a top. I think it's going to go down from here. It may not be felt immediately. It's like the frog sitting in water that's getting hotter and hotter. And I think at some point you'll see people starting to jump out because they simply cannot afford the high rates that we see right now. That's why also, if you look at the credit card delinquency rates and so on, they move up. And this can take a while. I mean, this is the process. It takes a while. And then when people are starting to jump and they are forced to sell their homes, that's the moment when you see that the full effect starts to unfold. So we're not there yet. And that's also what we see. The maybe there where this deadweight anchor is keeping things down. I think the Fed here are being too observant and too cautious about inflation, which is now 2.3 CPI. I know the sentiments, the expectation of inflation are higher, but we know how it is with expectations. It's like what we saw yesterday, or we saw last week, or the last month, is what we expect will continue to happen. What the situation is in the business cycle and in the real economy is that it's the big wheel turning. And if people are spending less, the consumers, which are the real economy, starting to spend less, then there will be a downward force on inflation. And one thing that is still there is that you have still a lot of capacity in a lot of companies, and they haven't started to shed that, because after the COVID, you could see how actually everybody was expanding. Everybody did well after all the stimulus coming out. I think you're going to see that this is putting pressure down on inflation. And we saw the latest development. Oil is now below. You may also find that chart there. I put that in. You can see how it's actually broken lower in the I think it was in April. We saw that, and then it stayed down there. I think we've seen a bounce now. We'll see inflation famously. Then we've seen it down to the 2020 when we had what I call the inverse Volcker moment, the moment where they overstimulated the economy. So Volcker was too hawkish, or to bang the inflation down by raising rates. And now we see here that they are actually they did the quite opposite. They overstimulated into a supply crisis. And that has now reintroduced inflation to the system. But the problem is, where we need to stay, level-headed here, is that long-term shift is not the same as short-term development. And I think what you're going to see is that you can have a short-term development to the downside in inflation that then will be taken over by a move up. So you can see this whipsaw kind of thing again, just so that inflation goes over now because the Fed is becoming, or is overly cautious now and hawkish. And that will then create the deflationary bust. You're going to see a recession. And then they will come in with the guns blazing again once more to try to fix things, overreacting again. And then I think you're going to see the unfolding of the next inflationary regime. And I think that is also what the commodity charts are suggesting. I think lower commodity things start to unfold. It's called labor market participation rate. That's what I was trying to say. I just
labor force. Yeah. LFPR.
Yeah. But that is also an important factor, obviously. But so in terms of getting the rate correct, the labor, the unemployment rate, but the number of people unemployed are moving up, and that's what people also should focus on. So what is that is worrying here? It's simply that we're not seeing the labor market strengthening at this point, and then we're not. And again, we're seeing that at a time where we are in this no man's land, you can say, because we're also not seeing it deteriorate. But I'm just fearing that what we normally see is, as we just said, also with the market spreads the yield spreads have been inverted, and they come back up again and they uninvert. That's the moment when things are starting to unfold, and we are just on that that level now for some of the shorter time frames. We don't see the short-term yield starting to decline very rapidly or very strongly, which is a normal sign. Also, we should see into a recession or into some of the fast slowdown of the economy. And everybody's having it's becoming a self-fulfilling prophecy now that when M2 goes up, Bitcoin goes up because everybody says so. So it's like becoming that kind of, I see an end to it. At some point, there'll be an end to this, to Bitcoin, and we'll see a big top, and it's going to come down strongly. And then it will have to show itself the strength of Bitcoin into a potential recession. I think that will be the real test for Bitcoin at some point. And for a lot of cryptos, they're going to get crushed. So still expecting the animal spirit to take over. And a lot of cryptos and altcoins, tokens, whatever they're called, and Bitcoin driving that, pulling the liquidity in, and then you start to see that circulating in that space, and then you have the whole thing going.
So you expect for Bitcoin more specifically a more short-term path towards the 20,000, and then a pullback, or how would that movement look like?
Yeah, I work with different scenarios there, because or talk about tariffs, everything is fine again, the economy is not in recession. We are now, people start to see that, the ones coming out in April, they're talking about that was maybe a little premature, premature on that. And I think that that kind of spirit will start to build. The animal spirit will build, and you'll start to see people trying to find, where can we jump into something that will give us, the 2 times, the 3 times in returns, and not just the 5-10% we expect on, Bitcoin. So I think that's the normal thing that we will see. That's the normal cycle that will happen there. So yeah, I could see small caps. Technology small caps could do extremely well into that phase.
So it will be, I can see clearly now the rain is gone type of song.
Yeah, exactly. You can see clear now. Yeah.
And we've also talked about gold last time, and you did mention that it would pull back as of 3,200, which did not happen, to my great joy. It hoovered all the way up to 3,500, and now
having gold is a security to get liquidity. It's going to get the dollars, which can help you in your particular situation. It's not because gold just does well there, because it's in that environment itself is where gold is not doing well. That 2008, March to October, 6 months, and it dropped 35%. Silver dropped 60%. And again, 35%, 40%, 50% into a very bad deflationary bust. Yes, it's overperformed by far what I expected. Hands down on that, it's correct. But still, I would be cautious into that kind of phase. But for now, yeah, why not? And I'll just wait buying it until we have seen that kind of correction, and until the moment where silver and platinum and so on catches up. And we have to remember, everybody has been forecasting that silver will be catching up to gold for the last 2 years, and it hasn't. So again, we need to see who is actually in the driver's seat here. And I think that gold has been front-running things a little here. And when things are being front-run, it may also pull back bigger than people expect. So that could be a good time for that. But the next phase here, with the deflation, whatever, and physical gold is absolutely a necessity. And I'm doing the same myself as well. Even at these prices, I'll start buying in, and I buy in and keep building my physical position there as well.
So to wrap up it a little bit, to make it nice, compact, and juicy, we could say that if I just summarize or try to summarize what we talked about, the housing is kind of we're seeing cracks that will trigger the Fed to intervene if it gets bad enough. The labor market is cracking, but it's still doing pretty well relatively. Like in the meantime, we might see an uptick in risk-on sentiment that will start peaking as of after the summer, so after July, August, up until autumn, and get that blow off up from that moment on. How would you then position right now? If you have just a blank sheet? you would give some actionable trading ideas?
I mean, again, it depends a lot on people's risk profiles here. So, of course, this is not recommendation or anything like that. I think I'm wise enough, which may be stupid, but I think at least I am, to ride what I call the blow off top. So I'll stay with risk asset there, building our positions even and actually getting in very, very aggressively, because I think you're going to see a commodity bull, precious metals, but also commodity bull starting when the Fed comes out. So it's really about how aggressive you want to be and how much you want to front run the next kind of phase that I see. Can I be wrong on the phases? Yes, I can. But for now, we're in the blow off top, and I try to ride it and then see if I am wise enough to get out in due time.
Great, Henrik. Thanks a lot for this update. Is there maybe like any other things? So you've also a website on Swissborg. People can also subscribe to your regular macro updates. Is there anything you want to share or conclude the conversation with?
Yeah, so really the best way to get hold of me is to look me up on X at Henrik Zeberg, and then there will be links to where I can. Please do not follow any of the fake links or any of the scammers, but this is where I'm people up to follow my profile, and that's it. Make sure you